Okay, good evening. We'll go ahead and get started. My name is Darren Redthorn. I'm with the Department of Agronomy and Horticulture here at the University of Nebraska. I'm a forage crop and residue specialist. We have with us tonight Mary Drunowski, who's a beef systems specialist in the Department of Animal Science, and Jay Parsons, who's a biosystems ag economist in the Department of Ag Economics. Give you a little bit of a background about why we're here tonight, just briefly before we move into the main part of the discussion tonight. One of the things that precipitated this has been numerous questions that we received based on current corn prices and also limited availability of perennial grass pastures. A lot of producers are asking if we can grow forages on cropland as an answer to providing some additional feed for the cow herd. Some of the questions that we've been getting and some of the ones that we hope to answer tonight are, will growing corn compared with growing annual forages? Which one of those nets more income? Can annual forages pay the cash rent? And then we'll also look briefly at is converting a pivot to perennial grass economical for pasture? As we move along through this, some things to keep in mind. One of the things that's important to do is that we continue to seek the best long-term use of cropland that's both economical and sustainable and still provide some of the flexibility in the operation. We also need to be aware of some of the long-term familiarities that we have with some of the crop rotations. Specifically, what we're going to be looking at tonight are some of the expenses that are associated with making a lot of these changes or modifications in some of these systems. And then also there's just the uncertainty of a lot of the alternative markets that are unfamiliar to some. You know, all these coupled together oftentimes make it difficult to implement new agricultural practices. Tonight, what we're going to do is look at 5 different scenarios. After we finish with a scenario is when we'll try to answer a question. With the number of folks that we have watching tonight, I think one of the things that we'll try is if you have a question, type that in the chat box, and I'll try to manage that as we move along, and then we'll try to answer 2 or 3 of those questions after each scenario. If you have a question, go ahead and type it in, because I think we've also got a follow-up plan to maybe address some of these questions that may take a longer response over email or a telephone call if that's more appropriate. So with that, I think we'll begin with Jay. Jay?
Right. Okay. So thanks, Darren. And so we're going to take a look at, like Darren mentioned, a number of different scenarios, but basically kind of the baseline that we're going to build from is what happens if you're not going to grow corn and maybe grow some forage or whatever. So we'll start with just a basic view of how we'll look at this economically, and we're going to try to keep it simple. So the first question to ask is if you're not going to grow corn on your crop acres, what does that get you? And of course, one of the things that gets you is your reduced cost. You don't have to pay to grow corn. And then the other thing that it does, of course, if you're not going to grow it, you're not going to reap the benefits of it. So you're not going to have corn grain to sell, and you're also not going to have corn stalks to utilize at all for your own cattle or to rent out to somebody else. So not growing corn would have that effect on you in terms of reduced costs and reduced revenue to the operation. If you're replacing that with a forage, what does that get you? Of course, you're going to have some cost there in terms of getting that established and able to use in terms of any fencing or watering considerations that go with that. And then also, of course, it's going to give you some revenue in the form of actually having forage to utilize. And we're going to, again, keep that pretty simple tonight in terms of just what how many AUMs might be produced there, what the value of those might look like based off your stocking rates and whatnot. So everybody's situation will be slightly different. We're going to keep it pretty simple though in our example. So, the tool, the economic tool that we use to look at this is what we call a partial budget analysis, where we just look at the positives compared to the negatives and see how those sum up and how they balance out. And as Darren mentioned, we'll have several different scenarios to go through, and we'll have a tool set up for each of them and some numbers plugged in there, and we'll discuss that a little bit. But in the simple things I just walked through, both increased revenues and decreased costs would be positives. Those are over here on the left-hand side. Of course, the top part of this is increased revenues from your forage that you decide to put in place, and the decreased costs are this cost savings of not growing corn. And then on the right-hand column in the gray are the negative things, which is the cost associated with the forage, and of course the revenues you don't get from growing corn. Okay, so that's kind of the basic premise that we'll use to look at these different scenarios. So first of all, just a sideline, we needed someplace to go to get the numbers. You will have your own numbers for your own budgets, your own yields, and everything else that goes with that. We just went to our UNL crop budgets, and I don't remember if we wrestled over it or not, but we just picked one. It seemed appropriate. So you can get to the UNL budgets at cropwatch.unl.edu/budgets. So the corn budget, basing our numbers off of, come from there. This is what the actual website looks like. And if you scroll on down, you'll see the budgets for the various corn budgets that we have there. We're going to use an irrigated corn budget, and the PDF would be right here. And you pull that up, and let's see, which one would we use? 31, is that right? 31. 31. Let me get to it here. So I'm going to scroll on down to budget number 31. Okay, it looks like this, right? And the details here aren't all that important. You, of course, want to put in your own details, okay? But when we say that you save the cost of growing corn when you switch and decide not to grow corn and grow forage, it's important to realize what you don't save out of this budget. And one of the things that we are not going to count as a savings, so we do not include in the savings, is the ownership costs on your power equipment. There's an ownership column up here at the top where the field operations are, and you got power equipment and the implement being pulled behind. So on the bottom end here, this is about $37 worth of ownership costs on equipment. We're going to assume you still own your equipment. You're just going to use it over fewer acres. So that would not be a cost savings. You still have that ownership expense attached to it. And then the big one is down at the bottom where you have real estate expenses and overhead. Okay, so the bottom section of all of our crop budgets have what we might call fixed costs associated with just business overhead, which is charged at 20 bucks an acre, real estate opportunity costs, and then real estate taxes. You still own the land, you're still using it, you still have all of that stuff, and you still have your overhead. So those are not savings either to the operation for not growing corn. So what you do save, of course, is all of these materials inputs, your fuel, your labor associated, and your repairs associated with the equipment there. You do save that, and of course the operating interest expense that goes with that. So so that's one sidelight just to keep track of, if you will. Okay, so with that as a background, I mentioned the tool, partial budget tool. I'm going to use an example of that we dubbed the risk scenario planning tool, and it was developed by the Right Risk Education team, which I'm a part of. The primary person that partnered with me when we put this together was John Hewlett, University of Wyoming. But Wyoming, Colorado, and Nebraska have team members on this. And this is available online. It's just at rightrisk.org/tools, and it's a second tool down, but I'm going to take you directly there. If you put /RSP tool on there, there's a tool page for it, and this is what that looks like. I've already pre-populated some versions of this, so I'm not going to download anything here. But I'll just point out that there are some examples up there. There's a guide. I think it's like a 30-page guide that explains the tool and the examples. Okay, so this is free to download, and you can go get it and work with it yourself. No cost to you. Just use it all you want, and we encourage you to do that. So that's just some background. So, sorry, we can actually go to the tool at this point, right? I can remember this stuff. So let me pull up one of the tool examples, and if I get the right one up here, put this one right here, and we got it blown up. And I'm going to scroll down because we're replacing corn with an annual forage. Okay, and the part I'm going to talk about right now is what do we save from not growing corn, which actually constitutes the bottom piece. So on the positive side of the ledger, we reduce our costs, so we don't have that corn production cost involved. And as I said, this doesn't include the land costs, which of course is a big one. And it doesn't include the ownership costs on the equipment. But if you account for all of the inputs and the fuel and the lube and the labor and repairs, it comes to $473.70 an acre. And the budget we used is the baseline for this. So that's a cost savings. That particular budget presumed a 230 bushel actual yield per acre. We just plugged in $3.50 for a corn grain price to start off with, so it's about $805 worth of revenue. And then we put in $15 an acre for the corn stock rental that you wouldn't have available either. Okay, so netting out here, you're giving up about $830 worth of revenue for a $473 cost savings. And you're replacing it, of course, with annual forages. So I'm going to turn it over to Mary now and go back to our PowerPoint because she has some annual forage numbers to look at. And we'll go next.
And so the next side of that comparison, right, is what do we put in for the value of the forage? And so one of the simple things we can do is just compare it to, well, what could I go and rent pasture for? So we're using pasture rental rates that the Ag Econ department sends out a survey every year, and you guys are so nice to reply. And if we go to the Ag Econ website, we can download the farm real estate report, and on table 11 on the farm real estate report, we can actually see what the current cash rental rates are for pasture on a monthly basis. And so in this particular scenario, if you just kind of look across on the average, we're running somewhere around $50 statewide. And so we're going to use that scenario. We're going to use that scenario here. So Jay's going to have that number. Sorry, okay. So the other part of this is looking at the annual forage systems. And if we go to beef.unl.edu/cropland, I want to show you where we came up with our scenarios. And this is the beef.unl.edu/cropland. And then if we go down to planning annual forage systems, we can look at an article that Jerry and I put together where we kind of went through some options for essentially having grazing for 6 to 7 months. There's kind of two scenarios here. We're going to use this first system, System A, which is essentially planting a cool season like oats in March, grazing in May and June. And then in a second field, we're going to plant a warm season forage and graze that essentially once we get off the cool season. And then The next scenario would be we come back on this field 1 and then plant a cool season again. So essentially we have grazing from May until November with this particular system. And our assumption here is that it's eastern central Nebraska irrigated land. So thinking about that 230 bushel corn land, our assumption is that we would essentially need 140 acres for 100 cow-calf pairs. And again, we get that 6 months of grazing. So now I'm going to turn this back over to Jay, and he's going to show you how he plugged those numbers in to, actually, I'm not going to turn it over to Jay. So,
So you got a bunch of numbers to go through.
yeah, so I actually needed to show you here, essentially, this 140 acres is essentially 1.4 acres per pair. And I told you we kind of had 2 fields. And this is that scenario where you have 2 fields. You have the oats in the spring that you're going to come back after you graze starting in mid-May. And then in mid-July, you're going to get off of that and go over to this warm season. And then you're going to plant a cool season on that field again. So if we look at this scenario, one of the things I wanted to point out to you is we did assume grazing efficiencies, grazing efficiencies of 50% for the cool seasons and 40 for the warm. With increased grazing management, we can increase that a bit, but for this, that's a pretty reasonable number. And we also assumed that our irrigation is essentially getting up our oats in the spring and giving it a little bit of a wetting in the fall, and then most of our irrigation is going to happen for this warm season. So what do the costs look like? Essentially, we're looking somewhere around $20 an acre for seed in the spring, summer, and fall. We've got some cost of seeding, which we use the custom rental rate of $15. We use fertilizer at 40 pounds of nitrogen per acre for our spring and our fall, and then essentially 80 for our summer annual. And then we have our $9.63 per acre inch for irrigation, and that's essentially the irrigation cost that was in that corn budget. We assume those costs are the same. We added some fencing costs in, $5 an acre essentially, and then, it's $10 an acre split out on the spring and the fall because we're going to use that same fencing, which comes down to essentially a cost of $25 per pair per month for spring, $40 for summer, and about $27 for fall. Now, this is what Darren and I looked at and said, hey, this doesn't look too bad. You know, the system probably will pay. And because when we look at the total system cost on dollars per pair per month, we're at about $29 per pair per month. And compared to that pasture rental rate where we're talking somewhere around $50, that looks pretty good. But what we haven't accounted for is what the potential revenue would be on the corn side.
Right, because we don't have land in there. And of course, that's not a savings off of that corn production. So, so let's go to the tool and actually plug those things in. Right. So I'll scroll back up here. Make sure I get the right one. Okay, so we have the corn numbers at the bottom, and now we go and plug Mary's numbers as she went through on the forage production. She had $123. Let's do the cost first. The forage cost per acre was $123 an acre, and she had $3.39 for interest charges on that. So that totals to $126.60 an acre. And like I tell my students all the time, we're economists, so we can go to the nearest penny just because. Anyway, so we go back and say, okay, so what's that producing for forage? Okay, and our assumption was we had 1.4 acres per head. Remember, as we went through there, because 100 head ended up getting split out between the 2 fields over time. And then 6 months of grazing assumed. If you plug in $45 rental pair per month, or rate per pair per month. That comes out to about $192 in assumed value there as far as that grazing goes. So you net out ahead here, right? But of course you got to take into account the pluses and minuses from the corn, and you're giving up a lot in terms of corn revenue. And so the bottom line down here is this turns out to be fairly negative, $280 to the bad, I guess. That's what it is, if you want to look at it that way. So anyway, so that's what we were talking about in terms of if you take the land costs out of here, which of course you still have, in either scenario, this doesn't look quite as rosy as it did initially. So one of the reasons we built this tool, and this isn't that fancy as far as just being a spreadsheet that does the partial budget thing, but one of the things we did, obviously with our right risk group, we're interested in risk. So we made this to where you can actually vary a couple of things. So I want to go ahead and take a minute and show you how you can play some what if games here. Because the natural question some people might have was, well, how low does corn price have to go before, you know, this is a break-even thing, or before it makes sense? And I can't remember exactly, but I think it's like 280. If I plug in 280 here, we start. Is it lower? Oh yeah, it is lower. 250. That must have been before we put some other stuff in. 250 was it? Yeah. See, we're still losing money at 250. So you can play the what if game and get down here pretty low. We've tinkered with these numbers enough times. I don't know what this actually comes out to, but about 230-ish corn. Okay, everything else being the same. That's would come out to DNA. That makes starting to make a little sense. But that's pretty low price for corn, and you're probably going to have government programs and crop insurance and all kinds of things like that kick in. So anyway, so back to the risk thing. What you can do on this is you can come down here to the bottom of this tool, and you can actually make any two cells up above vary if you like. So the ones I chose here were corn grain price, the number I was just messing with, which sits, this is a spreadsheet, so it sits in cell H28. And so I just say, okay, let's make that 3.5 is my most likely value, but let's let it vary from 2.5 to $4 in terms of how that nets out on that side of things in terms of possible prices. And then the other thing I varied here was cow grazing costs. And we had that up here above in cell C9, which is right here. Okay, just choosing the address and typing it in. And we had 45 plugged in there as the most likely value, but let's say that varies from $35 up to $75 per pair per month, okay? And both of these little boxes up here are checked to include. If you uncheck those, it just doesn't include those in the analysis. But this is a nice little spreadsheet, so if you click run, what's going to happen is it's going to build a distribution of values around these numbers for corn grain, and it's going to build a distribution of values around these numbers for corn or for cow grazing costs, and it's just going to do a random draw. We did 1,000 draws of this. It basically built a distribution of possibilities. So when I click run, it's actually running through all those, and one of the things you'll notice, those parentheses stay up there, meaning they're almost all negative, and they are all negative. But this is how that would turn out in terms of possible net benefit. Worst case scenario, right? Remember the worst case here as far as making the changes is that we have really high corn grain prices and really low value to the grazing. So that's down here edging up towards a loss of $400 an acre. Best case scenario, according to the numbers we plugged in there, going the other direction, is something like $56 to the negative, okay? We ended up at about -280, which is right in here. You know, it's about about a third of the time will be worse than that, and about 2/3 of the time it'll be better than that, okay? So in addition to changing the numbers that you have in the actual spreadsheet, if you want to look at this yourself, numbers that you have up here up above, you can put variation around any two cells. You just pick the ones you want to and see how that turns out. So I think that's what we wanted to show you with that one. And then I think our next thing was to go ahead and look at the what if on the cash rent. Right. Oops, sorry, I didn't hit the slideshow.
So the next question was, well, what if I'm not a farmer? Can I afford to pay cash rent? And so essentially going back to those costs that we just walked through on that annual forage system, the $123 an acre in cost plus the interest, we're at 126. So now what are we going to charge for cash rent? And of course we can vary that, but remember our scenario here was East Central Nebraska. I just went back to that real estate report that I showed you for the pasture rents and looked at what cash rents were for that region. And in this case, on that kind of ground, it was $245 for irrigated. So now we're at a total of $371 for total cost per acre. And we're assuming we can get essentially, we need 1.4 acres per pair. So we're at a total cost of $520 per pair. And if you divide that out over those 6 months, we're at $86, almost $87 per pair per month. So we're in the bad about $30 per pair per month compared to what pasture rental rates are right now. And Jay actually plugged some of this in again into the right risk system, so we could kind of look at some variability and see how much that makes a difference,
Yep.
Jay's a good guesser.
I had to guess which one it is. Okay. So this is just plugging in the 126.60 up here. I just consolidated the 123 and then the interest costs on one line, and then plugged in the cash rent assumption of 245 that Mary mentioned. These numbers over here, the 1.4 and the 6 are the same. This is the number she calculated as break even. So I just did this so it looks like a break even type of scenario. But obviously, if we put in this at 45, which is what we had there on the other example, it's not so break even, right? It's a situation where we have a lot more costs than we have gain. So again, the natural question would be, can we put variation around this? And if we scroll down, we can do that. Now the cow grazing cost was already in here, varying from 35 to 75 with the most likely. I guess I had 55 in here left over from an earlier one. We can go ahead and leave that there, or maybe we can use what Mary mentioned earlier, just 50 as an average if we wanted to. It doesn't really matter. Corn grain price isn't here any longer, so let's put this in here as just cash rent. Cash rent. Oops. Let's get my space in there. The typing police are going to get after me. Okay, and cash rent, and I'm doing this just to show you how you can manipulate this yourself. But if you go back up here, cash rent was in this cell right here, the dollar value, and that's cell H7. Did you have a comment? No. Go ahead, Amber, if you do. So we'll go back down here, and we want to make this H7 instead of H28. So it changes the correct cell. Okay. And then we had 245 in here, I believe. And Mary, I'm going to ask you what you want to put in on the low side.
Oh, I don't know. Let's say 180.
180, okay. And
It's like the
Darren,
price
put
is
for
right.
the high side. High cash rent,
High cash rent, 325.
325. Right. Okay, so anyway, so we put all those in there, and then we
Type thing included.
oh, sorry. Mary caught me here. I didn't include this one. Let me include that one. Okay, let's rerun that. Okay, so it's running through all those scenarios. Still a lot of negatives, obviously, with that cash rent, and that's what we looked at. Okay, so worst case scenario, you'd be down here losing a little over 250, so about 260, I think, 255. And at best case scenario, still losing here like 43 bucks. So anyway, you can play with that too if you like, if those are uncertain. Now, we were talking about whether this was a realistic scenario. Generally, on an annual decision, you're going to know your rents. So it's not really realistic to put variation around it. But if this were something that you were making some sort of multi-year commitment to a situation, it might be realistic in certain circumstances, I guess is the point, to make one or both of those variable.
And the other variability that you could do is plug in what the cash rent is, but maybe on the productivity in terms of my assumption of 1.4 acres, maybe that's a good assumption, maybe it's not.
Mm-hmm.
You could vary that number as well as an opportunity.
And for that, you just go down that C8. So you can this label is just a label, so you can type whatever you want in there. But you change this to C8 and then vary this from whatever you want, 0.5 to 1.8 or something, whatever your variation is. Okay? All right. I think that puts us up where Mr. Darren can actually speak.
We're gonna do questions first.
Oh,
Is that right?
Yep. You have questions?
We have 2 questions.
We didn't have them.
One, well, I prodded a couple of people along.
All right.
So Kevin and Christine both asked a question somewhat related to each other, so I'll read through both of them. Kevin said that cost per month per pair is a cost. The question is, what about the revenue from the value added in the gain in the calf? Seems like a comparison of cost per month per pair and value added of raising corn, at least so far. Then Christine says, should the value of the calf be factored into the corn versus forage calculation because you're exchanging selling grain for selling calves?
So you want to address them?
Well, both questions are really the same question, and that is why compare to a pasture rental rate rather than doing a scenario where you come up with the income from selling a weaned calf. That's how I read those 2 questions. And essentially, in economic terms, we're looking at it like opportunity cost, right? That I could go and rent this pasture and have the same calves that I would sell at the end, and it would cost me $50 per pair per month, versus the scenario where I'm going to use this corn ground. So in terms of the profit from the calves, you would make it, the way I look at it, I'd make either equal or more money from that pasture, then why not just go to pasture? And so that's why we use that particular scenario. I actually started off exactly the way you guys were asking, because I'm an animal scientist and not an economist. And I was trying to plug in what annual cow carrying cost is and make assumptions on what a calf would sell for. And indeed, adding in a lot of things that I don't know the answer to at this point in time. There's a lot of variability with that. And in the end, it's all about, could I feed these cows cheaper? And pasture seemed like a reasonable comparison.
Yeah, and the only thing I'd add to that is, we're basically, you got to draw your boundaries around your enterprises somehow. And in this case, that opens up a whole nother ball of worms in terms of how your cattle perform and all those other aspects that we didn't want to muddle into this same webinar. So we're looking at this basically as your land being your enterprise here. What's it worth? What's it producing in terms of AUM versus bushels of corn in this case? So yes, we fully acknowledge that if you're running cattle on there and growing calves, that your product you're actually selling there is your calf. We understand that, but that opens up another variable to look at. And for tonight's purpose, we aren't getting into that.
So Christine had another question. So you're using corn grain revenue to buy feed for the calves you have anyway.
Essentially. There's expenses traded off.
Yeah, the expenses trade off. And then Kirk.
We're going to keep them on the cows out there raising calves.
Yes.
Yeah.
So Kirk.
Feeding cow.
Yes. Kirk says, better yet, our statement, don't use this type of forage for cows. This type of forage would be better used for stockers.
There you go, Kirk.
That's
if you have, and Mary's the one that should be interested, but if you have good forage that the growing cattle perform well on, logic would say don't feed it to your cows, right?
Yes, and we could have this is actually, I think, the next opportunity in terms of scenarios is to look at it for backgrounding calves, because indeed the forage quality is high, and in terms of looking at that value, we can make some assumptions and some scenarios revolving around how they might perform and see whether or not that will pencil out.
Mm-hmm. Great observation.
But again, in this case, we still need to compare it back to something, and that something is what's the value of the corn versus the value of the calf, and making assumptions on the market.
Okay, y'all ready to move to the next scenario? Okay, so I'm up next. So based on Mary's comment, when we were looking at some of the annual forages, and we thought, man, those things would work, and then, really they didn't. We got this information on this irrigated perennial pastures. A lot of this work was developed at North Platte by Jerry Valesky, and so we thought we would look at, can we do the same thing with perennial pasture? Can it be used to pay the rent? A lot going on with the irrigated perennial pasture. Not going to show you that list of budgets, but budget 47 is grass establishment. We assumed it was all established, no-till. If you go into that spreadsheet, they're making the assumption that it's tilled. So they've got some tillage practices with some costs there, which we took out. So from the establishment, basically what we were looking at was $70 an acre for seed. Had a roundup, and the application cost around $10. Had $14 for a drill seeding. Had a little bit of starter fertilizer there at $18, and then 3 inches of irrigation at $6 an inch to get that stand established in the fall. Total cost per acre for establishment was $130 per acre. There's some fencing and water development associated with this. The cost of that is pretty expensive. This was for 5 paddocks, but it includes a lot of infrastructure, primarily with the fencing and also the tank development at $116 per acre. What makes the perennial pasture a little bit confusing for me, in addition to those establishment costs, you've also got an annual operating cost for these perennial pastures. The cool season grasses, they're lovers of nitrogen fertilizer. They use somewhere 150 to 160 pounds per acre. We charged $72 per acre to that. 12 inches of irrigation, again at $6 per inch for 72, and then $20 worth of maintenance. So the annual operating cost for irrigating perennial pasture was around $164 per acre. So one of the things that's an advantage we thought to the perennial well, it is an advantage to the perennial pastures, is you don't have to establish those things every year. So one of the things we did was look at it over the long term. So what this includes is the annual operating cost, or that $164 there, and then the amortized establishment cost. So perennial pasture for 1 year would cost you $126 or $426 per acre. If you leave that stand in for 2 years, that's reduced down to around $300. To get it below $200 per acre, you've got to have a stand life of about 10 years, and then leaving it in for an additional 5 buys you almost another $10 per acre. So the point is that it's awfully expensive to get perennial pastures established, but the cost per acre is reduced quite a bit over time. This is some information that Jerry had put together on irrigated pasture annual returns. And he had 2 different scenarios. He had grazing at $55 per pair per month with 3 different production levels. All 3 of the production levels were for 6 months. On the high end, that return was $412 per acre. On the low end, it was a little bit less than $250. Second scenario was for $45 per pair per month. The same AUMs per acre and same length of grazing period. On the high end, that was $337 per acre, and on the low end was a little over $200 per acre. So the question that we were interested in, we had the same questions that we did for the annual forages. Can we make this perennial pastures pay the cash rent?
Okay, so we just plug those into the tool again, and these here were the numbers that Darren had, the 164 on the annual operating costs. We use 5% interest on here, so we did 6 months of interest on that annual operating cost, and that was another $4 an acre. And then this was the amortized cost that he had attached to that for 10 years and 5% interest. So the 199.96 is how he had that totaled up in the chart that he had on the cost side of the ledger. Of course, the corn stuff down here at the bottom is still the same. We're trading off the production expenses and the revenues that we get from that. This was the middle piece of what he had there. So he had 1 acre per head, his middle example that he had. And then I took the high end of $55 for the rental rate per pair per month, 6 months of grazing in all cases that he had outlined. So this was the $330 worth of revenue that he had. And if you pencil this out, you see the margin here, roughly $130 that that's looking at. But of course, it's not going to balance out what you had on the corn. It's a little better than what we had on the annual forage side, but it's still negative. And we could still do the same thing down below in terms of running some variation here in terms of the cow grazing and the corn price, 250 to 4. So running that same variation across, we can kind of see how this works out. It's still looking pretty bad, but at least there is a small smidge of a chance that you're actually going to come out ahead, $7 on the top end. It's only about a 1% chance that will happen. So a little better than we had on the annual side, but still looking pretty bleak in terms of overall. Of course, we were right here in that negative 208, I think, range. So roughly about 45% of the time, you're worse off than what we had in our scenario above, and about 55% of the time, you could be better off. But still, a long ways to go for it to actually be profitable.
And just to remind everybody, as we've been talking about these budgets, remember this is using our assumptions on costs and revenue, and so it's important that if you really want to know the answer for you, you need to put in your own.
Exactly. Yeah. Yep. So anytime you look at anything we do that we're pulling off of our budgets, it's probably not going to fit very well in some aspect of your own situation. So,
Ready for some questions?
Yeah.
We got
you guys should put out the slides. Okay.
4 or 5 questions.
4 or 5 questions. Okay, go ahead.
Okay.
It blew up.
So
You were talking, so they're probably forget.
Yeah, they're probably wondering why. Yeah. So better yet, that was the last question. Brian said with corn harvest, nutrients are exported. With grazing, nutrients still remain in the field.
Mm-hmm.
That comment starts to be a pretty common thread over these next 4 or 5 questions. Crystal says, hi, Crystal. As I was thinking, it does not seem balanced to assume that you would need the same number of pasture acres as you would need in the forage system. So she's talking about the perennial pastures versus the forage because of the yield differences, I think is what she's referring to.
Yeah,
Seems like
we did it on an AUM.
we did it on an AUM basis.
So that
Seems like you would get much higher yields from the corn ground than a typical pasture. You and I, Mary, had that discussion a little bit earlier, kind of related to some of the marginal ground issues.
So, but to be clear, that we're not comparing 1 acre of pasture to 1 acre of crop ground. We're comparing essentially 1 cow month to 1 cow month. So we've already accounted for the difference in productivity in those two, and you are totally correct that the amount of yield you'll get is different. One of the interesting things on that is that if you looked at Darren's scenario versus my scenario, because of the way the annual forages really have a very finite growing season, we actually needed more acres per cow month if I was doing an annual forage system, even though the productivity during the growing component is actually greater. So it's a good point, but we were looking at per AUM or per animal month.
Yeah, in terms of the nutrients and the soil issue, of course, we're not accounting for that here. We're just looking at a snapshot. So those would be, some longer term effects, multi-year effects that we're not accounting for here. You could put some variation in there a little bit in terms of maybe the productivity and say it grows in productivity. Unless you really know, you're kind of guessing at it.
And I'll read these other questions. Chris says that Brian's comment about nutrients staying in the field, how would you value that?
Yeah, well,
And I think those are longer term than what we're.
Although, one of the things that you have to think about is if you look at our scenarios of adding nitrogen, right?
Mm-hmm.
So we're adding nitrogen, the perennial, into the annual, and whether or not over time you would not have to do that. I assume that with the perennials in particular, we would have data to suggest we need to continue to add nitrogen to make that system run at 8 to 11 AUMs per acre. So from that standpoint, I think we're not winning a lot. We might win some on phosphorus, for instance.
yeah, so there's two ways you can say the land is more productive because you're doing something to make soils better, but also on cost savings, you don't have to have.
Yeah, soil organic matter would be the other one, right? If you're building soil organic matter, theoretically, you're building productivity. What's the value of that? That's the $10,000 question.
Yeah. So I think these next two comments and questions are going to lead into the next thing, Mary, that you're going to start. Brian's again talking about reduced cost of fertilizer for the next crop, increase biological health of the soil, increase the organic matter. Depends on the cattle operator and manager. And then this is the important one. They just have a first initial. L. Atwell says, I was thinking about it, valuing improved soil health and helping add to a rotational system, which all that plays together in this next part, Mary, that you're going to talk about. So what about cover crops, especially rye and corn and bean systems?
And the one thing that was suggested that's beyond what we just talked about with nutrients and organic matter was weeds, right? And whether or not you would break some weed cycle that might reduce your herbicide needs. And here's the challenge with this is there's a lot of mites and a lot of maybes that we don't, every scenario is going to be a little different and we don't know what that looks like. So what you can do is put in the values you want to assume on the budget and see what you think it looks like for you. With that being said, I wanted to look at, okay, well, does it ever make sense to use annual forages? And one scenario I wanted to look at was using cover crops, and one that we've been working on quite a bit is oats and brassicas after corn silage. And so essentially what I did here is very similar to the spring scenario in that system A, but there's a few tweaks here because as a cover crop, we're fitting it in after a cash crop, and this cash crop would be the corn silage, which means it's going to be a little bit later planting of the cover crop. So you're going to reduce your productivity just a bit relative to that scenario where we were grazing. So some of this is adjusted a little bit here. And as you can see, we're still somewhere around $21 an acre in the cost per pair per month, which looks really good if you say, hey, I'm going to charge all of my cash rent to my corn silage. I'm already going to do corn silage. This is something I can do beyond that. Does the value outweigh the cost? And in this case, that looks really great, right? It does. Just from the forage standpoint, not evaluating anything to do with the soil side of it, we can afford to put in this oats. So Jay put a scenario in here where we were looking at, okay, well, this scenario, the oat brassicas with the corn silage, and then comparing that to corn.
Yeah, Mary said, can we plug this into the tool? And I was like, well, what are we comparing? So, so it made something up, okay? So I was like, okay, so what are you actually changing? Because it's a win, right? If you charge all your expenses to your corn silage and then you just add this on, you're getting an extra value out of your land, which you've already paid for, essentially. So I said, okay, so let's go back to our corn example, and let's suppose that we were going to harvest this corn for grain. So we were going to have corn grain sales and corn stock rental of $830 an acre, but now we're not going to harvest it for grain. Instead, we're going to harvest it early for silage and add in forage afterwards. So we wouldn't save all of the corn growing costs, we just save the harvest expense. And that comes out, and again, this is just pulled straight from that budget, so you'd want to use your own numbers, but it's $53 an acre. That included harvesting the corn, the combine, obviously, the grain cart, hauling it away. There's a trucking cost in there, and there was a drying cost in there. I just pulled all of those out of the budget, the things associated with actually getting the grain in a bin and then to market. So if you pull that out, it was $53 an acre for that piece. And then instead, you're going to harvest it for silage. So you have the silage harvest expense. And I apologize, I think this was budget 38. I'm not 100% sure of that, but we do have one corn silage budget. And I just pulled the expense that we had in there, which is $279.50 an acre. And then I went ahead and that budget assumed a 26 ton per acre yield on the silage. And this $40.25 for the value of the silage happens to be what that value needs to be in order for this to be roughly break even. If you scroll on down, we're pretty close. Actually, I shouldn't do it that. I should do it this way, because if you take the corn grain sales minus the expense, and you take the silage sales minus the harvest expense, they're roughly equal to each other. So I made the silage and the corn roughly equal in terms of how they net out. So, so the added value here is the production cost associated with the forage, taken away from the actual forage value that Mary had mentioned before in terms of what you'd get out of it, which is about she's had 50 days in there, which is 1.64 months, and then half an acre per head, and that's about $147 an acre. So when you net that out, the 147 minus the cost, that's where you come up with this bottom line here, about a $75 benefit per acre by going ahead and switching from corn grain to corn silage, and then followed with the forage. Again, that's under the assumptions that I have there, which are kind of reasonable in terms of prices and yields and costs. So, so that's what we had there. Did we want to attach? We didn't have anything to attach. But a person could play what if with that, and you can put variations down here in terms of corn grain price and grazing, just like we did on the other ones. And yeah, so we have it up here. We had 45 on this particular one. If you run it, this one actually has some positives, so I'll run it so we can see some positives, okay? And given those numbers, of course, not surprisingly, it comes out pretty positive bent, because we had 75 kind of in there as the default. Best case scenario is we made upwards $280 an acre on doing that. The 75 is actually pessimistic here, just because we put $45 in for the AUM value, and that was on the low end of where we thought it might be. But anyway, so this one comes out pretty positive. Not much of a chance that it would go negative given the numbers that we had. I think we had a 3% chance of going negative. Okay. So I think you had one more example to walk through here.
Yeah, so the other cover crop scenario is really looking at rye and a corn bean system. And again, I just used some numbers from some grazing that we've done in eastern Nebraska. Essentially, if we plant rye in late October or very early November, and then we're trying to graze starting in early April, you know, the challenge is you've got a very short window for grazing. You know, it might be 35 to 40 days. And so what I wanted to show you here is essentially I made some assumptions on the days of grazing. In this case, I did 35. Let's say I planted this after beans, and then I'm going before corn. I think that's probably about all we can get in eastern Nebraska. Still have those costs that actually are from that same system A for the rye, $20 an acre for seed, so seeding costs, some nitrogen, a little bit of irrigation, essentially 1 inch just to get the rye up in the fall. And then if we look at that right now, my cost per pair per month is $51. What's kind of interesting is that if I vary this number in particular, how many days I can get off of it, the reason I'm only getting 35 days is not that the forage runs out, it's that I got to kill it to plant something else. And so where this becomes interesting is to start looking at how much extra value do I get if I go an extra day or 2 or 3, and then what do I give up on the other end? And so this is another one of those scenarios that's worth looking at. But at 35 days worth of grazing, we're looking at a very reasonable cost per pair per month if we do not cause any detriment to the next crop's productivity, which in the case of this particular scenario, we did mead. We had no negative impact on the subsequent corn crop. So I feel fairly comfortable in eastern Nebraska that we can make this work. Okay, I think we are open for any more questions.
No questions.
Really?
Well, I answered the one that came through.
No, but
Okay. Well, we appreciate everybody's attending today, and I did want to just point out that a lot of the information regarding using annual forages, cover crops, corn residue, silage is on our beef.unl.edu/cropland website. And then one other thing that I wanted to highlight here is the crop residue exchange. It's a tool we put together to try to connect farmers and cattle people. So farmers who have crop residues that they're wanting to list to rent out, or you can even have on there, you can put cover crops if you'd like. And so there's some opportunity there to get connected and take advantage of that value that I just showed you in cover crops.
yeah, and at this website, we're also going to post our slides up there. We like True Extension people were working on them until the last minute, so we'll get them up there. So they'll be up there, and then there'll also be a follow-up survey that you'll get by email. And please let us know your thoughts on this webinar and any future topics you'd like to see us cover. We're looking for, as we already mentioned, there's limits to what we were able to cover tonight in the hour that we were with you here. But the questions seem to be endless of different angles we could take and different things we could look at. So please respond to that survey and let us know some topics you'd like to see us look at in the future on some of these webinars, or maybe even in an in-person program.
And we will send out this survey. We appreciate responses. Responses are always helpful. And be specific as you'd like for our next scenarios. See what we have.
And this was recorded, so that'll be up there along with the slides. And I think we're going to try to get that onto it, right?
Yep.
Okay. Yeah. So
that's why we had you register. So we appreciate you registering.
Yeah, Nancy wants us to look at poor quality land and lower production.
Yeah, we talked a bit about marginal land. This whole thing came about because we were getting some questions on really some quite good cropland. But I played around a bit with it, and it does look a little better. And so I don't know how far we have to go. And there's a bunch of assumptions in there, so that's a great question for our future work.
Yeah, and some of those can be changed easily with some of the examples we gave, but everybody's case is unique. One of the things I keep pointing out to these guys is one of the big things we assumed is you're keeping your combine and you're keeping your equipment there, so you're just spreading it over fewer acres. And when people talk about not growing corn, the question is you're just not growing it on that field, or you're quitting altogether. Of course, that's a major commitment. But if you quit altogether, you get rid of some of those ownership costs associated with the equipment and everything else that goes with that. But all of that warrants some pretty good analysis on your part to make sure that you're headed in the direction you want to go. So,
Well, we're getting a lot of good suggestions now.
for future ones, or
Yes.
Yeah.
Future ones.
okay. Make sure you remember what you typed in there and respond to our survey too, so we get it all in one place.
Here's maybe one. This one here is not maybe future. This one is Lance wants to know how would running more cows per acre affect the production of rye in the spring.
I think the key balance with that is actually being able to rotationally graze. And I would say, if you looked at what the scenario is that I put in there, that's probably very, very conservative. That was not rotationally grazing, that was set stocking. And so I think we could have gotten probably double the productivity off of that rye if I had just a simple maybe 3 paddock rotation. So that's a very good question, and it's worth making sure that you look at the assumptions and you can tweak them as you think appropriate.
Yeah, and of course, a good point on that is, part of doing more intensive grazing with the rotation side of it is your labor, and how you value that is up to you in the end, right? I mean, you could say I'm free. If I wasn't doing that, I was in watching soap operas or something. And those returns, if you don't put a value in there for your labor, you just need to realize that those returns are returns for your time in addition to how everything else nets out. So for some people, they look at that and they say, oh yeah, I can do that, I can do better, and so on and so forth. But just make sure that you properly account for your labor, either by putting it in as a cost or by realizing that those returns are returns for your time that, in theory, you could be doing something else with.
Okay.
We good?
Yep. Thank you very much.
Thanks, everybody.
Yes, thanks very much.